Hello traders, Gary Wagner here, just about 10:15 in Honolulu, 4:15 in New York. It is Monday, March 13th, 2017, and this is the Daily Report for Gold and Silver. As we await the beginning of this month's FOMC meeting, which is scheduled to commence tomorrow and be concluded by Wednesday, we have quiet action, almost a wait-and-see attitude, a hurry-up and wait attitude, I should say, as I talked about in our opening letter, with precious metals slightly higher, unchanged on the day, but certainly showing some potential support at 1200. That's going to be the focus of today's report. Gold futures are currently trading at 1203.90, putting it up about $2.50 on the day. The low 1202 and the high 1210. So we have seen an upside spike, of course, but as I said, as we go into this week's meeting, I do expect there to be a lot of quiet trading, paring of positions, so to speak, until the release or announcement, I should say, on Wednesday when the meeting concludes. Net change on the day about 0.2%. When we look at silver, that also traded higher, up almost 0.4%, but we know that's been under so much pressure recently at 1698, the low 1696.5, and the high 1716. Of course, one thing of great interest to us is the dollar index, and as you can see, that is also trading quietly today, up about 0.1% at 101.37. Well, it's finally the week of the FOMC meeting. That will begin tomorrow on Tuesday and, of course, conclude on Wednesday. The important thing about the meeting is not so much whether or not they're going to raise rates, but the question is, how much will they raise rates by? The fact of the matter is we'll probably see a 0.75% rate hike. But the real question is going to be what is the tone that comes out of the Fed? Is their stance becoming more aggressive, or are they still going to have major concerns that kind of keep them somewhat accommodative, but tightening at a desired rate, which is right now set at 3 rate hikes? This would be the first, of course, in 4 months and the first of this year. So with that in mind, I draw your attention to the technical factors that we're looking at. And the one thing that I can tell you is that the low that we saw gold trade to on Friday seems to be a low that could hold in terms of support. You know that it's on our radar. It is a 50% retracement, 1194, and then we have this harmonics that comes in at 1198, which is our 78% retracement. Of course, the retracements that we're looking at is our short term right in here, and that is really starting from about 1180 up to 1265, and our longer term retracement that encompasses the entire rally so far in 2017. It actually began the end of in December 2016, and that was when the market was trading at about 1120. So by encompassing these two and then looking for common ground, so to speak, I call it a Fibonacci harmonics, what we get is the real potential for this particular price point to effectively predict possible support in the market. Now, I do believe we should find support at about 1200. If in fact it does not hold this area, we touched upon this a little bit on Friday, but the only place it could go from there on a technical basis would be to the 61% retracement of the major rally that occurred this year, of course, and that would take you to about 1180. We talked about different areas of support, assuming that the market finds support at 1200 and begins to move higher and up off of that. Where can we expect to see some levels of resistance? Well, the first level that I've got pegged at is about 1220. That's a major level. There's a very minor one at about 1211, and then above that would be 1250. Those, and then of course at 1260, which is this top here, those would be the various levels I would look for resistance should the market find support and begin to move to higher ground. Interesting action, mixed action, I should say, in U.S. equities, with the Dow Jones Industrial Average trading lower by about 0.1%, closing off 21 points at 20,881. However, we did have both the S&P and the NASDAQ trading higher on the day, nominally higher, 23.74. That's up under 0.1%, and that's up about 1.5 points in the Standard & Poor's. And of course, when we look at the NASDAQ actually had the best performance of the indexes out there. A tech stock heavy index, of course, was up 14 points or 0.25% at 58.75. And then lastly, crude oil continues to drop, although the drop has really ceased in terms of the momentum, trading lower by about 0.2%, but below, well below at this point, $49 a barrel, and close to breaking through $48 per barrel as a supply glut continues to weigh heavily on the market. Oil at $48.38 per barrel. So as far as equities go, as I said, we had a mixed bag today. Dow Jones Industrial Average down, S&P and the NASDAQ index both trading marginally higher, both up and down. Prints were by about 0.10%, 0.1% in terms of net change. The bottom line is traders are sidelined awaiting news from the Fed that's going to come out in just a couple of days. Now, what we are noticing is to have that upside surge and spike, then begin to trade sideways or consolidate, and then continue on the path as it's been in a upward momentum path. So my expectation is if the interest rate hike comes out as expected and the tone is not too hawkish in terms of an aggressive stance by the Fed, we would probably see this market continue to track higher. Of course, this on some optimism as to new policies and the agenda by President Donald Trump as to him being able to enact it. Yet that's another story, and that could have downside pressure on the market. But for right now, I expect at least for the next couple of days to see sideways movement in U.S. equity. And traders, lastly, although the actual fall has really slowed down in terms of its steepness, realize last week crude oil lost about 9% of its value all in 1 week. We're looking at a daily chart in oil. We've got a set of channel lines that come in, very, very short-term channel lines. eSignal calls this a linear regression. I've always called them channel lines, but we obviously have a bearish bias. As you can see, the nature of the way this channel line's moving. We're now at the bottom of this channel. So the question is, will we see a spike up or will we break below that? And if we do break below that, well, where would the next couple of levels be that we'd want to look at? Obviously, our first target that we talked about last week was it going to between $48 and $49. Well, we've pretty much achieved that. We're trading at $48.42 currently. So where would the next real target be? On a technical basis, I think that we would easily see 46 again. That's based upon this top right in here. So, as you know, we went in flat over the weekend with no active trades, no active positions on as we await some sort of announcement by the Fed. At this point, it is, at least according to probability and the FedWatch tool, there's 100% certainty that we will see an interest rate hike. And I think that that is probably correct in that all of the statements coming from members of the Federal Reserve kind of back that up. So it's not whether or not they will raise rates, but it's going to be the basic tone that comes out of the comments after the FOMC meeting that really sets the next sort of wheels in motion. What we do want to know is what kind of tone will be presented by Janet Yellen as she makes comments right after this week's conclusion of the FOMC meeting. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.